Hello everyone, this is Tejas from Trendline, and in this video we look at companies poised for growth in 2023. We'll analyze companies with high forecaster estimates across different parameters on Trendline's new analyst estimates dashboard. The parameters in focus include high 12-month share price upside and strong revenue growth year on year in Q3 FY23 and FY23. Share prices of these companies with strong analyst estimates outperform their industry and the Nifty 50, meaning these stocks performed well in 2022 and are expected to perform well in 2023 as well. The top four companies that made it into the list include Aditya Birla Fashion and Retail, Ashok Leyland, Sun Pharmaceutical Industries, and Bharti Airtel. All these stocks outperformed their industry and the Nifty 50 in share price change, with Ashok Leyland leading the pack with a rise of over 20% in the past year. However, when it comes to the 12-month share price upside, Aditya Birla Fashion and Retail comes out on top with an upside potential of nearly 32% in 2023. Let us now dive into these stocks individually and understand why analysts are positive. Let's start with the pharma stock that outperformed its industry by a huge margin in 2022, Sun Pharmaceutical Industries. The Indian pharma industry has been under pressure after the tailwind from the pandemic subsided in 2022. Nifty Pharma underperformed the benchmark index by over 15% in 2022. Besides the unusually high base in 2021, intense competition in the once profitable US generics business put pressure on Indian companies. However, Sun Pharma's share price bucked the overall trend and rose 18.5% in 2022. Analysts expect the drug formulators revenue to rise over 13% in FY23, banking on its specialty product portfolio in the US. Looking at shorter term estimates, Sun Pharma's Q3 FY23 revenue is expected to rise 12% year on year due to continued traction across its Indian businesses and in US specialty products. Net profit is expected to rise marginally year on year in Q3 as raw material prices and freight costs put pressure on margins. Sun Pharma's EBITDA margin rose in Q1 and Q2 due to better product mix, benefits from the PLI scheme, and favorable currency. However, higher freight costs and inventory costs are expected to normalize EBITDA margins in Q3 and Q4. Over the long term, EBITDA margins are projected to reach FY21 levels of around 27.5%, as higher margin specialty products and new product launches can improve profitability. Sun Pharma has invested significant capital in its specialty products in the past 3 years and is now reaping its benefits in the US. As specialty products revenue contribution rose to 15% in Q2 FY23 from 11% in FY22, Sun Pharma's specialty business also grew 27.5% year on year to $200 million, largely on the back of Sequel, Lumia, and Winlevi prescriptions. Its management expects this growth momentum to continue. India and US business growth is important for Sun Pharma as it derives around 30% of its revenue from each of these two geographies. Given all the positive factors we discussed, analysts are positive about the drug formulator. Brokerages have a positive outlook due to two main factors. One, sustained traction in its specialty products, and two, industry outperformance in branded generics of the domestic formulation segment and also in emerging markets. However, one key risk that investor will have to watch out for is its US FDA inspections, the frequency of which has increased lately. Sun Pharma's Halol facility has been placed under import alert by the US FDA in December after an inspection. Next in line is a leading telecom company, Bharti Airtel. Telecom companies in India need to be on their toes to keep up with technology developments and grab new opportunities. In December, Airtel and Jio 5G were made available on iPhone 12 and above for free trial. These two competitors have been at the forefront of advancements. With high capex plans in FY23, analysts expect Bharti Airtel's revenue to rise at a CAGR of 16.5%, a lot faster than it did in the last 5 years. Airtel's revenue has been on the rise quarter on quarter for the past 6 quarters due to tariff hikes and growing total and active subscriber count. Airtel has the highest revenue per user or ARPU in the industry. In Q2, ARPU improved by 3.8% QOQ to rupees 190. In comparison, Reliance Jio ARPU was at 177.2 rupees. Analysts believe rising ARPU, tariff hikes, and better operating leverage will bode well for Airtel in terms of margins. Even though analysts expect Airtel's EBITDA margin to fall marginally QOQ in Q3 due to high operating expenses, they believe it will continue on its uptrend over the next 2 years to reach 53.7% in FY25E. Mobile services contribute over 80% of Airtel's total revenue. Growth in the Indian market, which is the biggest revenue contributor, is key. In the Indian wireless subscriber base, Reliance Jio is Airtel's major competitor. Airtel's market share stood at 30.4% in October as per the latest telecom data. In October, Airtel's total and active subscriber count rose year on year, and more importantly, its active subscribers as a percentage of total subscribers remained the highest in the industry at 98.08%. This is important for the company as higher active subscribers increases the ARPU, leading to revenue and net profit growth. Analysts are positive about the company's superior margins, stronger subscriber growth, higher 4G conversions, and the launch of Airtel 5G Plus. As a result, 21 out of 33 analysts who cover Airtel have a strong buy rating with an average share upside of over 14%. Analysts are also positive about the company's capex plans. Airtel plans to spend more on transport and the rollout of sub-gigahertz spectrum. It also plans to increase spending on its broadband, enterprise, and data centers. Let's now look at a company with the highest share price upside of over 30% among the stocks in focus, Aditya Birla Fashion and Retail. This apparel company reported its highest quarterly revenue in Q2 FY23, and analysts expect its Q3 earnings to top Q2. However, in Q2, the EBITDA margin fell 236 bps year-on-year to 12.9%, mainly due to rise in other expenses, which increased on the back of advertising spends, rising 2.5 times year-on-year. The company has ramped up its marketing expenses after dialing it down in FY21 and FY22. After weathering multiple lockdowns, ABFRL is now set to capture the rising demand in the textile industry. In December, the company acquired 8 digital-first lifestyle brands to cater to its younger customer base. ABFRL is building a portfolio of around 30 D2C brands in the lifestyle categories, including beauty and personal care. The majority of its brands are at a very nascent stage, having revenues in the range of 15 to 55 crores. With multiple avenues of growth available, analysts expect its revenue to rise at a 2-year CAGR of 33% over the next 2 years. Even though EBITDA margin has fallen on account of high ad expenses in Q2, margins are expected to rise over the next 2 years according to brokerages like ICICI Securities and Motilal Oswal. Analysts expect the EBITDA margin in the Pantaloon segment to rise the highest from 14% in FY22 to 21% in FY24E. In the Q2 earnings call, the management said margin improvement will kick in from increasing private label contributions, which has better realizations. Revenue from all segments is expected to rise over FY22 to 24E. Revenue from the ethnic segment is projected to rise the highest, but Motilal Oswal expects this segment's EBITDA to be in the negative until FY24. The company plans to add another 10 to 12 brands over the next 12 months and create a portfolio of 30 new age digital first brands in the next 3 years. Of the 20 analysts that cover this company, 16 have given it as a strong buy as they believe multiple avenues of growth unlock different opportunities in diverse industries. In addition, ABFRL's strong execution capability is reflected in its ability to scale up a series of strong brands in the past 10 years. Finally, we will look at an overview of the second largest commercial vehicle manufacturer in India, Ashok Leyland. This auto manufacturer has a strong presence in the truck segment. Analysts see a share price upside of 20% in 2023. One positive factor for the company is its strong growth in the heavy truck and bus segments, supported by price hikes. Ashok Leyland has taken price hikes of 1.8 to 1.9% in Q1 FY23, followed by a 1% increase in Q2 and another 1.5% increase in Q3 thus far. In Q2, revenue growth was driven by volume growth of 65% year-on-year. Net realization per vehicle also rose. The growth momentum is expected to continue in Q3 as analysts expect the revenue and net profit to rise year-on-year in the back of sustained traction in commercial vehicles. Ashok Leyland's revenue is set to rise at a rapid rate after stagnating for the past 5 years. According to ICICI Securities, the need for new trucks driven by replacement demand, aging of the fleet population, and better productivity of new multi-axle trucks is expected to drive the demand. Ashok Leyland's domestic heavy volume has already grown 113% year-on-year in Q2, which is more than double the industry growth. Its market share in the medium and heavy truck segment has risen 10 percentage points to 32%. Brokerages are also positive on the company's strategic initiative to consolidate all electric mobility vehicles under the UK subsidiary Switch. Falling commodity prices, price hikes, and cost management is expected to help EBITDA margins to recover back to FY18 levels by FY24. Despite the frequent price hikes, customer retention remained high in Q2 as market shares increased. With all these positive factors at play, no analyst has a sell rating on this stock. Brokerages are of the opinion that tailwinds in the industry will be utilized by the company to drive revenue growth and add market share while improving margins through price hikes and cost management. So these are the four companies that are poised for growth in terms of share price, revenue, and net profit in 2023. You can find more information about these companies and their industries on trendlyne.com. This is Tejas signing off.